Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special report on home affordability. We produce the Wizard Home Loans Affordability Report every month. And what we do is work out how much it costs of the take-home pay to service the mortgage on a median house. This is a single take-home pay on the median house nationally. We also do it for the various regions, and you can find out more on our website. The key thing is here that home loan affordability improved a record amount in August for a couple of reasons. Firstly, house prices fell quite sharply, about 2.9% in the month, and interest rates, the average 2-year fixed rate, that fell below 9% by 13 basis points for the first time in over a year. So a combination of lower house prices and lower interest rates have helped improve affordability significantly. And we're back down to 74% of take-home pay needed to service the mortgage on a median house. Obviously that's far too much for one income, but if you've got a couple of incomes you might be able to do it now. However, when you look at affordability, it's much worse than it was still in 2002, 3 and 4. Back then you could afford to buy a median house on a median income. It took up about 40 to 50% of your take-home pay. So what next? Where are we going with home loan affordability? Well, on October 1, we're going to get some tax cuts. That will help increase take-home pay, which will improve affordability. We're also seeing house prices continuing to fall. The Reserve Bank says house prices will fall 15% from their peak, which was in November last year, through to the end of this year, early next year. We actually think house prices will fall 30% from that peak over the next 2 years. But obviously we're on the outlier there. Effective interest rates though, will they keep falling? Well, after the dramas on Wall Street in the last week, it's possible they may not keep falling, because those dramas mean we pay more for the foreign debt that we have. We have about $200 billion all up. About $135 billion of that is debt held by the banks on our behalf, essentially, for all that mortgage borrowing we did over the last 4 or 5 years. And when dramas happen on international markets, that tends to increase the rates that we pay for our foreign debt, because foreign borrowers are less keen to lend to riskier investments like New Zealand. So what happened during the Bear Stearns drama back in March was that our interest rates rose about 50 basis points. So for example, if you've got a $200,000 home loan, that meant that your interest costs per week rose by about $20 to $30 a week. So what does this all mean? Well, the Reserve Bank is expected to cut the official cash rate, probably by another 50 basis points on October the 23rd. That may not be passed on in lower fixed mortgage rates. What it may actually do is simply stop them from increasing. So, affordability is likely to continue improving over the next 6 to 12 months or so, but as much because of falling house prices as it is because of falling interest rates. I'm Bernard Hickey. That was a special report on home affordability for interest.co.nz, prepared for Wizard Home Loans.